Good morning, everyone. Thank you for joining us today. Like we've done in the past, this will be our quarterly call with the investment research group where our members will discuss a market overview as well as performance of the discretionary portfolios that we manage here at Duncan-Williams. As a reminder, the information that we are showing will be historical in nature, so past performance is not a guarantee of future results. If you have questions about your tax situation, please consult with your CPA, as we are unable to give tax advice. Also, if you have questions following this presentation, please contact your financial advisor, or there will be a phone number at the end where you can get in touch with them or with one of us, and we'll be happy to follow up shortly. My name is Joey Griesbeck. I'm the chairman of the investment committee and a member of the investment research group. Also with us is David Scully, our chief investment officer, and David Hager, our head of retirement investing and products. So I will begin with the market review for the first quarter of 2014 and also in April and year-to-date information. So after a year where U.S. stocks climbed 32% higher without much interruption, the first quarter was rather volatile, with U.S. stocks closing up slightly. Bonds were out of favor last year as rates rose and they lost 2%. But fixed income rebounded in Q1 as interest rates declined despite expectations for a further increase. Some of the key drivers of last quarter's market performance were geopolitical instability, slower global economic growth, and central bank activity. One of the biggest world events to happen so far this year is the conflict between Ukraine and Russia. As you may recall, it all began with protests that turned violent when citizens called for the resignation of then-President Yanukovych. Russia supported the ousted president and mobilized troops to occupy the pro-Russian region of Crimea. World leaders were strongly opposed to this movement and the ensuing election, where citizens voted to secede and join Russia. The EU and US have gone back and forth with Russia, imposing sanctions and making threats if peace cannot be met in Ukraine. The situation is far from resolved, as Ukrainian and Russian militaries have gotten involved with the violent separatist actions, so investors are on edge to see how the situation plays out. Prior to this development to start the year, emerging markets sparked a large sell-off in stocks, bonds, and currencies because of political turmoil in countries like Turkey, India, and South Africa. Also hurting these securities was the Federal Reserve's tapering, which initially caused higher interest rates and made safer investments like U.S. Treasuries become more attractive than emerging markets debt. Slower growth in China added to the downward pressure on emerging markets, but it also impacted global stock markets out of fears that the second largest economy would no longer demand as high level of goods and services from the rest of the world. Despite falling 6.5% in January, emerging market stocks rebounded in February and March and finished the quarter down less than 1%. U.S. stocks also fell in January in response to fears over emerging markets, but slower domestic growth concerns brought on by an unusually cold winter also factored into the decline. While employment numbers were positive on an absolute basis in December and January, they were far below expectations and the higher growth exhibited towards the end of 2013. The poor winter weather was used to explain away the weak job numbers and slowing housing activity that we saw throughout the quarter. February was a positive month for stocks as the S&P recouped its January losses and set new record levels. In March, the index celebrated its 5-year anniversary of a bull market from the market bottom of March 9, 2009, following the financial crisis. Over that time, the S&P gained 175%, and it continued higher until late in March, when the market quickly shifted sentiment from growth to value. As a result, momentum stocks like those in the healthcare and technology sectors sharply declined. The first quarter marked a changing of the guard for chairperson of the Federal Reserve. Ben Bernanke's term ended in January, with Chairwoman Janet Yellen taking over soon after. As expected, the Fed announced 2 additional rounds of cuts to the monthly bond purchase program throughout the quarter, reducing it by $10 billion each time. In the Federal Open Market Committee minutes, the Beige Book report, and Janet Yellen's testimony before Congress, the Fed acknowledged that winter weather had a negative effect on first quarter growth, but the central bank was still confident in the U.S. economy. Internationally, developed markets recovered well from the emerging market sell-off, and they were able to continue growing despite the Ukrainian conflict. European economic data showed the region continued to grow as manufacturing and services activity expanded, and the unemployment figures were slowly improving. Deflation remains a key concern, though, but European Central Bank President Draghi has assured the public that he stands ready to act with the new QE methods if necessary. Japan is an exception to the developed market increase, however. After gaining more than 50% last year, the Nikkei index entered a correction in the first quarter, and it lost another 4% in April to be down 12% year-to-date. April has been volatile for other areas of the market, particularly for momentum stocks that started the month with continued selling. U.S. equities as a whole finished the month higher as corporate earnings results were better than expected and economic data improved following the end of winter. April jobs numbers came in much better than expected, and factory and business activity continues to expand. The preliminary first quarter GDP results were less than economists expected, but they were explained away by winter weather. The Fed tapered its quantitative easing by another $10 billion, so now they're down to just $45 billion per month in bond purchases, and they also noted seeing improvements in the U.S. economy. With this improving economy, interest rates remain low, however. The 10-year Treasury yield sits around 2.6%, which is 40 basis points off of its 2014 starting level of 303. Even after Yellen commented towards the end of March that the Fed could raise rates as soon as 6 months after the end of QE, rates recovered from their initial spike and never came close to reaching that initial year level of 3%. There has been much speculation in the markets about stocks being overvalued. We recognize that valuations are either at or slightly above their long-term averages, but the managers we cover are confident they still have room to run. Bonds were supposed to have a bad year with rising rates in 2014, but so far rates have actually declined, and as a result, fixed income is outperforming stocks. Therefore, we continue to recommend a well-diversified portfolio and a long-term perspective that can withstand the short-term declines in areas like emerging markets and high-growth equity. Our Chief Investment Officer, David Scully, will now discuss the performance of our discretionary portfolios and their underlying investments.
Thanks, Joey. So let's go ahead and jump right in here. Just as a review for those of you that may not have listened to our calls in the past, typically the way these go is we're going to talk about the models holistically and some general themes, and then we'll get into each one of our models. On the individual pages where we address each model specifically, each of the analysts that cover some of the best performing and worst performing funds during the quarter will address each of those funds. So right off the bat, you can see here that across the board, each of our discretionary portfolios did post positive absolute performance for the quarter, however lagged their relative benchmarks on a 3-month basis. While that is somewhat within expectations, and what I mean by that is when we see a strong rally in the markets and the blended benchmarks, typically these portfolios are designed not necessarily to catch 100% of the upside there. We want to participate in positive market movements, but not necessarily 100% because they're designed really more to hold up more on the downside. And so that's what we saw if you break it down on a month-by-month basis. And I'll touch on this a little bit more during our general themes. So this is graphically the same information you saw before. Usually what you see from our portfolios is either a stair step down or a stair step up as the portfolios obviously go from conservative to aggressive depending on how the markets move. The one that stands out here as being a little bit unusual is the balanced portfolio. We had a couple funds in there that held up particularly well, actually on the international side, and a couple others that we'll discuss here in a bit. So general themes. First, as you know, all 5 of the models posted positive performance, and that's good. People talk about relative performance, but you can't eat relative performance, is what we like to say. And so when you have a negative number, even if that's better than a benchmark, it still can be not an ideal situation for the end investor. So we were happy that all of our models did post positive performance for the quarter. They did underperform their benchmarks. A big part of that was February. February being the most difficult month. All 5 of our portfolios lagged their respective benchmarks. February was a month, even though it was a short month, where equity markets were up significantly. I believe around 4%, both domestic and internationally. And so underperforming a month like February is not unexpected for strategies like these. You saw on the page, or 2 pages ago, that our blended benchmarks were up kind of in a range of 140 to 180 across the board. That's because each component of those benchmarks performed well. The Barclays Agg, the MSCI EFA, and the S&P 500 all had really pretty good quarters, and so it's a situation that we're comfortable being a little bit behind. To break it down a little bit further, what actually happened generally in these portfolios, on the equity side, it was split. We didn't have all of our equity underperform or outperform. Some equity managers did well, others did poorly. And if you want to kind of draw a line in the sand, the ones that did poorly were, first of all, momentum-driven strategies on the growth side, as well as international strategies that had significant exposure to emerging markets. You saw during Joey's portion of the presentation that during the first quarter, emerging markets posted a negative return. Our managers have the ability, the flexibility to own up to 30% emerging markets. Many of them took advantage of that, and as a result did lag their specific benchmarks. On the other side, we did have some equity strategies that did well. Dividend-oriented strategies, particularly Federated Strategic Value, did very well. Also, small and mid-cap strategies tended to outperform large cap, and so you'll see a couple of those listed among our best leaders. Especially fixed income, these strategies all posted positive absolute returns. A lot of them are absolute return oriented, and so they don't have a benchmark. They're not looking to beat the Barclays Agg or any other index that's out there. Rather, they just want to post a positive return. So we're encouraged that each of them across the board was able to post a positive return. That said, the Barclays Agg had a very strong quarter, and so they lagged that benchmark. On the traditional fixed income side, it was a source of relative underperformance. Most of these funds were not able to match the 184 basis points generated by the Barclays Agg during the quarter, with the exception of Dodge & Cox, which performed really very well during the quarter. The way that we invest in these portfolios is we're trying to generate excess return, alpha, in our equity and specialty strategy investments. We typically use our fixed income position in the portfolio to be the money that we expect to hold up relatively well in difficult markets. And because we experience less volatility, less risk there, we typically are not going to reap the benefits of a strong upward move in fixed income markets like they had in January, where the Barclays Agg was up 150 of the 184 basis points they experienced during the quarter. So fixed income, a source of some underperformance domestically, other than Dodge & Cox, not very much outside of expectations. One bright spot in a couple of our more aggressive portfolios was our exposure to commodities, and those actually did pretty well for us. So this is the first slide for our individual portfolios. We'll go through conservative. Conservative was our portfolio that, on a relative basis, trailed by the most. A big portion of that actually is something that we experienced in trading the portfolio. For those of you that have been tuning into this call regularly, you'll remember that the Dreyfus Appreciation Fund made up a significant portion of the equity exposure in this portfolio. After significant underperformance for a prolonged period, and in combination with our due diligence on the strategy, we made our decision to remove the Dreyfus Appreciation Fund from this portfolio and replace it with Columbia Contrarian Core, which has turned out to be a positive move for the portfolio. But unfortunately, when you make a trade in mutual funds, there is some time to settle, and you will actually be out of the market for about 3 days. And during those 3 days, we saw a bit of a rally that our fund was invested in cash rather than in equity investments, and so that muted the performance of the portfolio disproportionately. Just to remind you guys how these slides are going to go, while we list a couple leaders and a couple laggards, we're only going to address one on each slide. Part of that is in the interest of time, but really more in the interest of that there is some redundancy between our portfolios, and so you'll see funds that appear as leaders early on continue to appear as leaders in subsequent portfolios, and the same is true with laggards. And so with that, I'm going to turn it over to our analysts.
So for Dodge & Cox Income was the top leader and contributor to this portfolio. It's an intermediate term bond fund that represents 10% of the conservative portfolio. Over the first quarter, it returned 2.3% compared to just 1.8% for the Barclays Ag. Compared to the benchmark, the fund is overweight corporate bonds, which was a top contributor to performance. And although they make up a smaller portion of the portfolio, higher yielding and lower credit quality bonds, as well as non-U.S. domicile positions, performed well and added to returns. The fund takes a defensive position compared to the benchmark by having a shorter duration, which ended up detracting from the fund since interest rates declined. But management still believes in keeping this shorter position relative to the benchmark, given the uncertain rate environment.
Hey, this is David Hager, and I'm the analyst that covers Thornburg International Value. This fund was one of the main detractors from the portfolio. It's one of our core international holdings. On the quarter, it was actually down about 4.75%. And the benchmark for this, which is the MSCI ACWI XUS, was up slightly at 0.61. So it drastically underperformed the benchmark. Part of the problems that the portfolio had was a lot of the stuff going on overseas. There was mixed economic data out of the developed markets, concerns over China's economic growth, uncertainty surrounding reform in Japan, and unease about the Russia-Ukraine conflict. So all these created considerable volatility in the overseas markets. So the fund's disappointing results reflect exposure to all those factors, as well as some of this company's specific issues they have within some of the holdings inside the fund. So we're well aware of the negative performance, and we are going to continue to monitor this strategy closely.
So our next discretionary portfolio is the balanced portfolio. This one had the best absolute performance and the best relative performance during the quarter. Big part of that is on the international side here. IV's got flexibility like each of our international managed owned emerging markets, but was able to navigate the space better, and we'll touch on that more in a second. But holding up on the international side helped a lot with the absolute and relative returns here.
Okay, so one of the leaders on this portfolio was the IV International Core. It outperformed the benchmark for the quarter. It was strong stock selection, had a positive return of about 1.17% on the quarter. The fund's sector allocation continues to favor stable over cyclical stocks. From a geographic standpoint, Europe outperformed, while emerging market exposure was the main drag on performance. This fund has about 11% exposure to emerging markets, which management thinks is reasonable considering that emerging markets has underperformed the last few years, and they think it's time that maybe that's going to turn around. So we'll see on that. But we're very satisfied with the performance of IB International Core.
On the laggard side, JP Morgan Large Cap Growth, as the name implies, it's a large growth equity fund, and it makes up about 9% of the balanced portfolio. In the first quarter, it lagged the Russell 1000 Growth Index by more than 200 basis points, but all of that underperformance came in the last 2 to 3 weeks in March. Before then, it was outperforming, but since it's a strategy that focuses mainly on momentum stocks, they quickly fell out of favor with the market at the end of the first quarter, and so that's where that underperformance came. The fund recognizes this performance as being outside of expectations because the monthly return in March was a historical anomaly for that actual strategy. Management continues to have confidence in its positions such as Amazon.com and Celgene, and it's continuing to find good candidates for the strategy. While we understand that this fund will underperform in a market that punishes high growth stocks, we remain confident in it and will maintain the position within the overall diversified portfolio.
Yep. So on the moderate growth portfolio, again, you see kind of the same type of range of relative underperformance. This is a portfolio that performed very well in 2013, and while we have seen some struggles early on in 2014 on a relative basis, I want to assure you all that we're monitoring each of these funds closely, that we very rarely make knee-jerk reactions, that we want to be very deliberate and thoughtful when we make a change to the portfolio. And so when we talk about each one of these funds, we'll give you some of the background, but also our thought process going forward.
Okay, so one of the leaders on the moderate growth portfolio was Diamond Hill Small to Mid Cap. It was up 2.07% during the quarter. It outperformed the benchmark. The fund's holdings in healthcare and energy provided the largest contribution to its absolute return. The drag on the portfolio was consumer discretionary stocks, consumer staples, and financials all kind of detracted a little bit, but that being said, we're still very satisfied with the performance that they posted during the first quarter.
On the laggard side, Sterling Capital Equity Income. It's a dividend-focused large cap value strategy that makes up 13% of the portfolio. This strategy is more concentrated in that it holds 34 names, so stock selection can have a significant impact on the portfolio. Over the quarter, 3 of its holdings, specifically Pearson, Mattel, and Rogers Communications, each experienced double-digit declines, and so the 3 of those companies together represent 126 basis point effect on the underperformance. Management of the fund is still confident in Pearson and Mattel to the point that it used the price decline as a buying opportunity to add to the existing positions. It lost confidence in Rogers, however, and replaced it with Verizon Communications, which it believes is a much more competitive company in the telecom space. While fund management is disappointed in the underperformance, it's happy with how the companies themselves have performed as a whole. It continues to believe that its high-quality portfolio of dividend payers is well positioned to participate in market and economic acceleration going forward, as well as offer downside protection in down markets. So while it was disappointed in its first quarter performance, it's still confident in the long-term benefits of the strategy and being able to outperform over a full market cycle.
So, growth portfolio, like you'll see, the benchmark is in the same range. The performance of the discretionary portfolio is in the same range as the previous one. Again, we're not looking to make any change to the growth portfolio. While we would love to see relatively a little bit better performance, this is not wildly outside of expectations. and so we will continue to monitor all of these funds closely, but with the expectation that we might not see any changes here. On the leader side, we've got the John Hancock Disciplined Value Mid-Cap Fund. We're actually very fortunate to have this as a part of the portfolio because this strategy is actually closed to new investors, but because of the relationship with Duncan-Williams, John Hancock has determined to keep this strategy open to Duncan-Williams and the clients at Duncan-Williams. So we're very fortunate to still have exposure to this strategy. It's one that performed very well in 2013, one of our best performers, and continues to do so in the early part of 2014. The strategy is sub-advised by Robeco, Boston Partners, obviously out of Boston, and one that we're very familiar with and feel strongly about. As you can see from the notes here, the outperformance was broad-based, having outperformed in 10 of 13 economic sectors that they monitor. They did well in consumer non-durables, and a couple particular holdings are listed here. One place where they did struggle during the quarter is they're unable to find real estate investments that they like. So a mid-cap value portfolio, typically that's where most of the real estate and REIT investments reside in the U.S. domestic market. And they're not capturing the exposure that they like to, mainly because they're not able to find the types of investments that they like. And as a result, that was the underweight there was a detractor to the performance.
All right, so one of the laggards on the portfolio is Ivy Asset Strategy. Ivy Asset Strategy is one of our specialty strategies, and this is truly what we call a go-anywhere fund. So by prospectus, they can invest in really anything that they want. So on the quarter, they were down slightly, about negative 1.28%, but really what's been going on is they've been reducing its allocation to equities this quarter. They've been kind of reallocating. So the fund ended the quarter with 77% of its assets in equities, and they actually have 13% in cash. So that cash also was one of the reasons the portfolio detracted. Anytime you have cash, it's not doing anything. The reason there's so much cash right now is management wants to pursue opportunities at the company sector and country level. And one thing we really like about the management team is they're always patient. So they might hang on to this cash for a little while, but they usually find pretty good companies to invest in, and they'll be patient with that. The fund continues to hold a position in gold. That's about 9%. That position is there. They use that as a worldwide currency hedge. Gold's been kind of volatile over the quarter, but they continue to hold that. I don't see them changing that anytime soon. Consumer discretionary was the sector that contributed the most to performance, and financials were the biggest detractor. So slightly underperformed. It's all equities benchmark, but like I said, this is a specialty strategy. The negative performance is within expectations. We'll always continue to monitor it, but there's no huge concerns with Ivy Asset Strategy.
That's our final discretionary portfolio, the aggressive. Had a muted absolute return here, but was actually outperforming through the end of February this year. And so March was a month that was particularly tough on it, and a big part of that was the momentum strategies in this portfolio. They're not listed as laggards, but we have two domestic equity strategies that invest pretty heavily in momentum stocks. That is the Columbia Select Large Cap Growth and the Wells Fargo Advantage Discovery. Each of those strategies, after having a very strong start to the year, gave a lot back in March and ended up underperforming for the quarter. You'll see here we have some funds that perform very well to offset some of that, but not enough to make up the difference between the portfolio and the benchmark.
The biggest contributor to the aggressive portfolio was Federated Strategic Value Dividend on a relative basis. As the name implies, it's a dividend-focused fund. It makes up 9% of the aggressive portfolio. And since it's more conservative in nature, we use it to balance out some of the more high-growth names within the portfolio. In the first quarter, it outperformed the S&P by more than 200 basis points as it gained just shy of 4%. It used this great performance as an opportunity to take some of the gains off the table in its high-performing names and reallocate to some existing positions. And it also continued to build up its REIT position, which it's been doing since late last year. They called it a surprise, but it's a positive surprise. Vodafone made a one-time special dividend in the first quarter. It was a large contributor to performance. And so if you've been participating in some of these previous quarterly calls, you may recognize this name because it was a laggard throughout 2013. Again, that's because it's a more conservative name. Its goal is to not outperform the S&P over the short term, rather over a full market cycle. It believes that dividend-paying stocks can outperform, and so it expects to lag in an extreme bull market like we saw last year. And so we're happy to see that our allocation to it in the aggressive portfolio paid off in the first quarter when it outperformed in January when everything was falling, and then again in March when the market shifted sentiment from growth to value.
Yep. And so, as I mentioned earlier in the call, that you would see some redundancy in some of our leaders and laggards. As a result, we've already covered both of these laggards, so it's not necessary for us to go through them again. You guys should be up to date on Thornburg and Ivy asset strategy. So with that, we'll conclude here. Just to give you kind of a brief recap, we've covered our market commentary from the first quarter. We also covered performance from our discretionary portfolios. As Joey mentioned in his initial comments, if you have any questions about this call or anything that the Investment Research Group can do for you, please do not hesitate to reach out to your financial advisor or to just dial in the number that appears at the bottom of the page here, and you'll be able to get in touch with either one of us or the appropriate person to answer any of those questions. Thank you very much for joining with us today.